for joining today. My name is Michael Joseph. I'm a Deputy Chief Investment
Sorry,
Officer.
we are actually just going live now. I'm about to
Okay,
introduce you. Yes.
wonderful. I wasn't sure. Thank you.
Okay, perfect. Okay, we are now live. We're going to get started.
Okay,
Um, we have Michael Joseph joining us today. He's a portfolio manager and deputy chief investment officer at Stansberry Asset Management. I'm going to pass it over to him now.
thank you so much. Appreciate it. And thank you, everybody, for joining today. It's my pleasure to be with you on what I think is going to be an exciting topic to talk about. Certainly a timely one. And as you can see, the presentation today will be 3 ways to invest in the age of AI. Um, I'm sure some of you can probably relate to this. It wasn't that long ago that ChatGPT was just, people were just figuring out what it was. And I remember, hearing so much hype about it and testing it, and maybe this will help with my work. And frankly, at the beginning, I wasn't that impressed, and kind of felt like it must be a lot of hype, and maybe this AI thing will go away and not be what everybody thinks it'll be. And boy, thankfully, I took it upon myself to kind of revisit it some months later, and again, I'm sure some of you can relate. It's become just part of my daily routine now, whether it's analyzing businesses and industries to, I have 2 kids that are picky eaters. Give me some dinner ideas. Just anything you could think of, and that's tip of the iceberg stuff, of course, to say nothing about autonomous driving and producing new medicines and all sorts of bigger picture things. But maybe that's a graspable way of just saying that, this is becoming more a part of our lives, and certainly is in our lives as investors. So excited to talk more about that, and let you know how we're steering investments for our clients, given that we are in the age of AI now. Just real quick, and appreciate the introduction there. But to hit on a couple points, I am again the Deputy Chief Investment Officer at Stansberry Asset Management, or SAM as we call it. I'll speak more to our company towards the end of the presentation. For those of you that managed to join yesterday and heard our Chief Investment Officer, Austin Root, speak, he mentioned a few of the strategies that we offer. I manage our income strategy and also co-manage the tactical select strategy, which he highlighted. So that's part of what I do here. I'm the author of a book, Dollar for 50 Cents, which focuses on closed-end funds, which is a fairly obscure part of the investment world. But for those of you that are interested in closed-end funds or want to learn about them, highly recommend that. Obviously, did my schooling in California and currently residing in Arizona, as you might have gathered from the cactus in the back. So here's the roadmap for today. Spend some time talking about the backdrop, investment and economic, then jump right into investing in the age of AI. From there, we'll take a step back and talk about investing beyond AI, and really what we think is most important to have in mind uh, in the face of all this disruption, change, and opportunity. As mentioned, I'll share a bit about our company as well, and if time allows, glad to jump into any additional questions that you might have. So the backdrop is one, as we'll speak on and then see in just a few slides here. Expectations are very high, and there's some clear drivers behind that. But just to look at it from a valuation standpoint, those high expectations are reflected in market multiples. And this chart is taking a look at the S&P 500, a simple price to past 12 months earnings, and excluding kind of a wonky period there in 2008, 2009, where the earnings of many companies went negative. This is, it's not an all-time high, but it's notably high, right? And especially if you exclude the tech bubble, it's about close to as high as you can get there. So does that mean abandon ship and we don't think this market is investable? Not at all. But we don't want to be blind to that either. The market as a whole is certainly pricey right now. That's on a 1 year basis. If you look at the Schiller PE, which has been pretty predictive of where the market goes historically, and the Schiller PE is simply looking at 10 years past earnings rather than 1 year. Then we see even more clearly, we're with one exception being the dot-com bubble, really at an all-time high. So this is reflecting very high expectations, right? People are paying high multiples because they believe that there's more growth and more returns to be had. Um, that said, it does start to, make you wonder if the market is priced for perfection, and anything beyond, these high expectations will cause some headwinds. I don't typically read from slides, especially if it's, our own words, but I think that we, really tackled the scenario well in a client letter that we issued at the beginning of the year. So if you'll allow, I just wanted to read those words verbatim. With valuations and expectations for future growth both high, we must see meaningful growth in the economy and earnings this year for asset prices to move higher from here. Full stop. This is not a market that will accept growth disappointments gracefully. So I think that's a really good way to frame it, and frankly, with a sort of almost euphoric expectation that some investors seem to have. I don't think you want to go into this market, thinking that it's easy money, that it's an obvious environment to make profits. As I just noted, like we have to see a lot go right um, to see the market continue to appreciate from here. We do think that it will continue to do so, but it's not a simple environment, to say the least. Looking at performance so far this year, energy has been the top performing sector. Um, Certainly the Iran conflict has a lot to do with that. Beyond that, though, it has very much been a tech-driven market so far, and even more so when you consider that energy, while technically the best performing sector, is really a small part, just around 3% of the S&P 500's weightings. It's really technology, which is by far the largest, that is driving the index. And especially when you consider the companies like Tesla, like Alphabet, like Amazon aren't technically tech companies. You could argue that this number might even be closer to like 50% tech. In any case, it's definitely dominating the index and dominating performance right now. Goldman Sachs recently did a sort of slicing of the index where they looked at what they grouped as AI stocks, or AI related stocks, and non-AI related stocks, and the gist of it was everything. Well, not everything, but the AI portion of the index was up quite a bit. The non-AI portion was down, and that's not to say that every non-AI stock is down. It's not to say that every AI stock is up, but certainly has been. There's a reason it's in the headlines. We'll put it that way. These charts that we're looking at now show the growth from last year and how it accelerated to still notable numbers, but the growth really started to accelerate last year when you saw individual companies cracking the $100 billion mark in their AI capex. And as huge as those numbers are, for most companies and hyperscaler companies, and certainly on a cumulative basis, that's continued to just go up and up and up this year and into next year. We're looking at $800 billion, nearly $1 trillion of capex in a single year. This is just like a huge growth driver, huge spending by these companies, and huge immediate benefit for any company that's involved in this sort of build out. And we'll get to some of those in a bit. NVIDIA's CEO Jensen Huang just I thought this was a notable quote in suggesting that the build out of AI factories is the largest infrastructure expansion in human history. It really is remarkable, and the numbers behind it can be mind-boggling. But we would say that this is not the only way to approach AI. There is an investment opportunity there beyond the infrastructure. We do think that the CapEx story, frankly, is still early, and there's a lot of opportunity and growth still ahead. But increasingly, we think it'll also be a story for real world companies. I kind of mentioned this early on how sometimes we think of like AI as just chat GPT making our own lives maybe a little bit easier or streamlined, but there's so many opportunities from AI and just every industry that you could really think of as the potential to be quite game changing. And with that, we would expect to see new products, new services, margin expansion, increased efficiencies. The internet has been an example that people point to quite a bit, to where you knew it was important, but you didn't really know sort of like what what it would actually mean, what direction it would head, and we ended up with new companies and industries that nobody even fathomed would exist. And I think that certainly uh, that same potential is certainly present with AI. Just a quick note on these, and not a not a recommendation on any of them, but I do think it's notable as well that in an environment where the past 4 years the IPO market has been pretty unsubstantial. There hasn't been a lot noteworthy, and the volume of larger IPOs has certainly decelerated since the sort of relatively recent peak in during COVID and beyond. The IPOs that are out there that are anticipated all have some AI component. OpenAI and Anthropic, obviously, kind of synonymous with AI. But then you have Databricks, which maybe not a household name, but viewed as more of an AI native software company that folks are very excited about. And then of course SpaceX, which at first glance, isn't that a rocket company? Sure, but they did merge with XAI not long ago, and I have also heard a lot of bull cases touting the future for SpaceX being a big growth driver being things like data centers in outer space and AI related things like that. So it certainly is a driver and a headline in this market. So pretty unavoidable in a sense. And despite some of that backdrop that I mentioned, we do think that this continues to be a market where you want to be invested. If you caught Austin's presentation yesterday, he went into this in detail, but to put it succinctly, you risk a lot by not investing in the market and missing out. And we do beyond that simple statement, we think there's concrete drivers and reasons that we should continue to see that growth that'll be necessary to drive this market. AI specifically, though, what to do here in an environment where clearly there'll be winners and losers. The market is starting to parse out what those will be, but it's I don't think completely clear. We are going into an environment where those early beneficiaries of the CapEx environment, they've done great. We do again think CapEx is early innings, but we will also just the law of numbers. We'll start to see that growth decelerate over time, and so we expect the market will shift more into identifying what are those companies that are taking these AI capabilities and benefiting from it. To try to approach investing in AI, we've really separated it into these three pillars, and one is leaning into the durable winners, those companies I alluded to that are already benefiting, that may have already seen their stock price go up, but because of their positioning, because of expected growth ahead, we think that they'll continue to be winners in this environment. Second part is, really taking a hard look, as we've done, at some of the companies in your own portfolio and deciding, the future predictions are imperfect, right? But you do have to try to determine what businesses out there are vulnerable to structural impairment, whether that means that AI can completely decimate their business and make it obsolete, or maybe it's not a complete you know, destruction of the business, but maybe it's impaired. Maybe their margins will not be what they were in the past because it's easier for competitors to to enter the market, or for enterprises to have their own version of, for example, a software that they previously were paying a license for. The third, and the one that we're going to focus on today because we only have so much time, and frankly, it's the pillar that kind of resonates most with me, is to target resiliency. In other words, in this environment where we know that there's going to be disruption, there's going to be changes, there's going to be winners and losers. What companies can we identify that, by their nature, by the assets that they own, by the business models that they have, will not only be resilient in this environment, but as a bonus, potentially benefit from AI upside. So I'm going to share a few examples of those type of companies with you now. Not recommendations, as I don't know who's on the other end of the proverbial screen here. Your situations will be different, your goals will be different, but I wanted to provide some examples of the type of companies that we're looking at to target that resiliency. The first is a REIT, real estate investment trust called Vici. And this is a not typical real estate when people think of like houses and apartments. They are, in their own words, an entertainment focused REIT. They focus on areas like gaming, hospitality, leisure destinations. They're branching out into more and more different types of experiences, but really they started and are still mostly associated with trophy asset casinos and hotels on the Las Vegas Strip. Irreplaceable assets that because of this business model, we're highly confident in. It's a triple net lease type situation, so it creates highly visible cash flows. They have inflation-linked escalators right into the leases. So, for folks worried about inflation, as I think everybody should at least be considering, how that impacts your investments. Really nice to know that, whatever inflation is, Vici's rents will increase to help offset that and help preserve purchasing power. Because of the sort of irreplaceableness of and how key obviously a casino is to a casino operator, we view these as well, not risk free, certainly strongly resilient in a number of environments. And the sort of recent example that we have to point to and to learn from is that during COVID, which, it hard to imagine a more devastating type of scenario for a casino operator. But even during that COVID period, Vici didn't miss a single rent collection, right? The money kept coming in, business was just fine. So almost the definition of resiliency there. The AI beneficiary part, there's a few things. For one, I think it's definitely the case that as we have more and more of our lives digitized, we're more and more in front of screens. I think that the demand for real world experiences, for being out there and doing things that are, can't be substituted by AI and by digitization, I think that'll be a theme going forward in the future. There's also this idea that there may be increased leisure time because of AI productivity. I think that's interesting. I don't know that that's the one point that we'd say for sure this is how it will work, but I think it's possible. I had to grab these as I was thinking about that. Is the leisure era finally here? Some of you will have seen stuff like this, like in the 50s and 60s. It was sort of like a very there's like huge interest in robotics and the Jetsons and that kind of stuff. And like how will our futures look with all the robots that are going to be here any minute? And there were all these ideas that they'd be so efficient and doing all the housework that we'd all have this abundance of leisure time. Of course, that didn't happen then. Will it happen now? Are we finally there? I think there's a case for it, but like I said, it's the upside, right? We aren't saying Vici is a really interesting company because of this one thing, but perhaps a cherry on top. Another company that we think fits the resilient uh, with some AI upside mold is CRH. This is another one that may not be a household name, but you probably have had some interaction with them, whether you knew it or not. This is the largest buildings materials company in the world. They produce a ton of construction aggregates and cement and kind of boring businesses like that. They're also a huge road maker. So they're in a nutshell involved in a lot of infrastructure megatrends. Some of that is AI. They have a connection to the data centers, but just as much or frankly more involved in transportation. As I said, hugely involved in roads. They are involved in water infrastructure, which our country here in the U.S. certainly we got some old pipes up there. We have some aged infrastructure. It's in desperate need of replacing. And reindustrialization in general. We've gone from this kind of just in time to just in case economy where resiliency in general is being prioritized. There's more companies coming home. There's reshoring. There's a focus on having resiliency in critical domestic industries. CRH, in our view, benefits from all of that. And again, just like the physical experiences, this physical infrastructure is one that is not going to be digitized away. There's a big need for it. AI beneficiary, I mentioned they are involved in the data center build outs that are happening right now. Those require a lot of materials. We hear about the chips, of course, but things like cement, which maybe aren't as interesting, just as essential. And so they're involved there. Also, and we're starting to hear more about this as folks try to wrap their heads around like how much materials and how much power does this whole AI build out actually take up. We really need to expand our power grid as well. Electricity is super important for this, and so electrification will also, in our view, be a driver that really helps boost CRH. This, like I said, not a household company, but one that's been around for a long time. Uh, their network is been built over 5 decades. You can see on the map here the different sort of portfolio assets that they have. This is kind of a neat aspect of the business that because they're dealing with like these quarries and really heavy materials, there's a big benefit to having this sort of network. It's really hard for somebody to come in and could be almost impossible, frankly, to rebuild something like this. The weight of the products that they're dealing with and the cost to transport it makes it a huge moat to have all of this wide portfolio in so many different regions. Another company we expect to see resilient with some AI upside. Moving along, one last one I'll share with you is gold, and I want to try to save some time for questions, and I think we're running up against our time, so I'll be a little brief with this. But the gist of it is we are a believer in this. Gold has a long track record of a chaos hedge and is a wealth preserver. While it's been a bit volatile so far this year after a monster run up, we think that the drivers remain intact for it to continue to benefit from central banks buying, from the commodity markets in general being bullish, which has historically been great for gold, and just as a hedge against fiat currency devaluation. AI upside might seem a little like, how does gold fit in there? But we really see multiple ways from it being that sort of chaos hedge in uncertain times. Certainly could be the case that AI will lead to some disruption that causes anxiety and uncertainty. In addition to that, we're seeing increasingly that AI leadership is becoming a sovereign issue. Governments want to have control over it, are investing at home to have their own capabilities, and the geopolitical tension that has certainly been a driver of gold. And in addition to that, the kind of inflationary concerns that are out there, potentially as governments help make policy such that it supports an AI build out. We could certainly see a push in the gold from that as well. These are some charts that in a nutshell show gold's recent history as a chaos hedge, from the tech bust to the great financial crisis, COVID crash. It's held up on all these, and certainly many other events going back thousands and thousands of years. Gold, it does have these periods though where, like, recently it's of course spiked up. It also has long periods of time though where it could be flat or even or give a good run on back, as long-term gold investors know. Because of that, we take I think a unique approach to it. We don't just invest in physical metals. We don't just invest in miners. We really have a four-pronged approach to investing in gold, because frankly, depending on the environment for gold, sometimes miners do better, sometimes royalty companies that finance operations do better, sometimes you just want to own the physical. So as an active manager, we rotate in and out of those. Stepping away from AI, it is important, as I noted. I think you need to have a game plan. I hope some of those thoughts help you in putting one together. But we think the most important thing that you could do in this environment, and frankly in any, is remember why you're investing in the first place. Have your own goals in mind, right? If you're an income focused investor, and generating money from your portfolio is critical for living expenses, maybe you don't want to spend a ton in some highly speculative AI stock that might not be profitable for several years, as a sort of generic example. You want to be thoughtful about what goes into your portfolio. Now, depending on what you're trying to do, we think that you can probably find AI related stocks for any of these goals. But how we approach it, how we tailor it, the size, it really depends on you. Sam is a portfolio manager that does not believe in one size fits all investing. So depending on your goals, maintaining wealth, generating income, growing it, or just having a balanced approach, we offer strategies for all that. Beyond that, that's the asset management part that we do a ton with, planning and helping people with their wealth management picture as well, making sure those things beyond simple investments are being accounted for. Real quick about our company, we're celebrating our 10th year. We manage north of $1 billion for families as well as institutions, offices all over the country. And as mentioned, I'm in Arizona, but we have folks in Texas, California, New York, Washington, and more. Have a steady track record of growing assets, particularly in 2022, which is circled there. Why is it circled? It doesn't look all that impressive versus the others from a growth standpoint. But as a reminder, that was a market where US stocks were down tremendously. Those tend to be the type of environments, frankly, that we've at least historically seen the best relative returns. And so lot of happy clients during that time period, fostered a lot of goodwill as we were able to protect them during a downturn. More recently, if you recall, Liberation Day last year, NASDAQ and S&P are in the red there, big drawdowns. The majority of our assets on display here, either modest dips or even positive performance in a highly volatile market. That's our team. We got together in Texas not long ago. It's not often that we get to all be in one place at one time. So glad we all got to have a picture there. Had some fun at a Rangers game. Um, Encourage you to follow us on social media. Not sure if I allowed time for questions. Glad to take them, but what I'll leave you with there is for folks that do want to take us up on learning more about the company, have a complimentary review, share some feedback about what we're doing, what your approach is. Highly suggest scanning that QR code, and if you have to click off of this, just visit our website. You should be able to track us down from there too, stansberryam.com. Just let us know you're interested. We can set that up for you. I'm happy to do it. Moderator, if we have any time, I'm happy to take questions.
So we are all out of time.
Okay.
I just want to say thank you so much for joining us, and I want to thank the audience as well. If you have um, any last thing you want to say before we hop off.
Just really appreciate the interest and attention. Like I said, if you want to learn more about the company, take advantage of that review. Highly encourage you to do so. No obligation to it. Doesn't mean you become a client by doing it, but I've never spoken with anyone that didn't learn something from it and find it highly valuable. So my strong encouragement to take advantage of that, and hope you all have a great day.
All right, great. Thank you, everyone.